Hello and welcome to Budget Decoded by HDFC Securities. I am Preksha Shah and today we'll take a deep dive into the sectoral impact of the Union Budget 25-26. Everyone's been talking about the taxation slabs and its impact on the personal finance. But what does the budget mean for businesses, investors, and the markets? Let's find out. Joining me today is Mr. Varun Lohchab, Head of Institutional Research at HDFC Securities. So he will help us decode which sectors stand to gain and which ones will face headwinds. Mr. Varun, let's get right into it.
Sure. No, thanks a lot for doing this. So, in terms of budget, overall, we believe it was a fairly, good budget in the context of how things are looking globally and India and at India level. I think if you see, there is a clear shift in the budget from the
Right.
sense that last three budgets mainly focused on capex and infra,
Right.
and which was the need of the hour at that point of time during COVID because the demand side was really weak. So government did the heavy lifting through government capex. Last budget itself, we saw some signs that government is trying to now get it more balanced and some push towards consumption, which has been a weak point in the economy in the last few years. And this budget, clearly they went all out and gave a big stimulus to the consumption side with the tax cuts which they have done. We believe they are sizable and more than what anybody was expecting. While there was a expectation of some relief on the consumption side, I think what they have given is more than what anybody was expecting. But at the same time, another thing which they have been consistent at in last 3 years is the fiscal prudence. Post-COVID, they have been bringing down that number. And this budget, they have actually again surprised a bit on the positive side with fiscal deficit target of 4.4% for FY26, which is 10 bips below what we were expecting. And therefore, you can say the only disappointment to an extent, because they have to balance out things, is that the capex number is a tad below what Street was expecting by around 3 to 4%. But at the same time, on revised number, it's still a 10% growth on a YY basis, so it's not too bad. But vis-a-vis what market was expecting and what stocks were pricing in, there was a bit of disappointment on the industrials and infra side. So clearly the winners in this in terms of sectors are all the consumption facing sectors. So especially the consumer discretionary, because this additional income coming in hands of salaried people and the maximum benefit is between the income levels of 10 to 11 lakh to 20 lakh. They are they would typically go and spend it on consumer discretionary products here, things like apparel, footwear, eating out, jewelry, and even things like slightly bigger ticket purchases like automobiles, which is passenger vehicles and two-wheelers, or real estate for that matter, especially the mid-income salaried, the developers who are catering to that price segment. So I think these are the clear winning
Winners
sectors.
of this year's budget. Right.
Yeah.
So, Mr. Varun, you clearly mentioned that consumption is the key takeaway from this year's budget. Considering the fact that there's higher disposable income in the hands of the consumers, are we looking at a steep recovery for this for the discretionary spend?
So see, this was a segment which was impacted in the last 12 months. Urban consumption had also slowed down given high inflation. And what we were witnessing in the economy was only K-shaped recovery, which is the premium segment was doing well, but the urban mass consumption was feeling the pinch. So categories like apparel, footwear, some of the other, eating out, all of them had slowed down in the last 12 to 18 months. We believe this, the change in the disposable income will definitely impact that segment the most in terms of positive impact. In terms of FMCG consumption, we believe the impact would be less, given the fact that the incremental money gets spent in that income class more on discretionary products and services rather than on staples such as FMCG products. So I think some of these segments will definitely see an uptick. The thing is, like, again, you have to do your homework and bottom up work on each of the stocks, because it's not that we were building in no recovery. So there was a expectation of recovery getting built in these segments in FY26 anyway. But I think what this budget clearly does is, it sort of gives us the confidence that now those numbers will come through which were penciled in terms of recovery, and in certain segments it might even be better than what estimates are. So I think clearly those are the biggest beneficiaries in terms of the segments.
That's quite insightful. So you mentioned FMCG. Premium brands generally tend to see an uptick from urban development, while consumer staples are benefited from rural consumption. What part of the market is better positioned?
So see, what happened in the budget per se will impact the urban consumption within the FMCG pack a bit more, and that too within FMCG again there are certain discretionary categories like food and beverages or skincare, cosmetics and all, which tend to get a bigger benefit of this sort of a disposable income increase, because I think it's a very targeted disposable income increase for people who have income levels between 10 lakh and 20 lakh. And if somebody has an income level of 10 lakh, their basic needs on soaps, hair oil and all are, toothpaste and all, they would already be consuming. Where would the incremental money go on? Some of the premium skincare products,
Right.
food and beverages products. These are indulgence or
True.
impulse purchases. And then, as I said, discretionary is a separate sort of a thing. So within FMCG, we believe companies which are more exposed to urban, so again, certain companies like HUL, Dabur and all have higher rural salience, but companies like Nestle, Tata Consumer and all have higher urban salience. So those companies will benefit more. The companies on the personal care or on the cosmetic side or food and beverages will tend to do better than some of the companies on the basic soaps and detergent side. So that's our view on FMCG. The other good thing for FMCG is that rural consumption has anyway been quite decent in the last 6 months. That has been actually one of the parts of the economy which is already recovering. And the good thing about the budget is again within the allocations to various segments, if you see rural allocations have seen again a decent uptick for FY26. So government's thrust has been one on lifting the urban consumption, but at the same time keeping the pedal on the rural schemes as well. So rural consumption will also continue to see an uptick in FY26 in our view. So therefore, overall staples, because even the companies which are exposed more to rural will also see a benefit in this year. But the bigger benefit in terms of the disposable income, the tax benefit has been a more immediate and a bigger one. That would be more for urban facing companies within FMCG.
Right. So this sector does have a bullish outlook.
Yeah.
What would be your top three picks given the sectors?
Yeah, so see again, our picks don't change just because of the budget. So, but from a sector perspective within FMCG, the top picks as a house which we have are Marico, which have a decent blend of both urban and rural, but more urban portfolio. Among the other companies which we like are, the liquor companies, both United Spirits and Radico, which are again beneficiaries of disposable
Right.
income increase. We like Jyoti Labs, which is a mid cap company in FMCG. So these are the top picks which we have, which were there even pre-budget, and we believe all of them will again be beneficiaries of the budget as well.
Right, right. So moving beyond FMCG, what would be your top three picks in terms of discretionary spending?
So in case of discretionary segments, if you see our top picks as a house, we have recently upgraded DMart and Nykaa.
Right.
We were negative on them for valuation concerns for quite some time, but we have upgraded both of them now, and we have a positive rating. We believe both of them would be beneficiaries of the recent move. Then some of the QSR companies we have positive ratings. So Jubilant is one
Right.
of our top picks out there. So I think these three would be the top picks within the paints. We are still not overly positive as a segment, and jewelry again, given the valuations are full and jewelry demand was already quite strong last year, we don't see incrementally big money flowing into jewelry. So I think apparel, footwear, QSR,
Right.
and some of the retail stocks like DMart. And Nykaa is more of a FMCG kind of a cosmetics and premium skincare play. So these are the topics.
Right, right. Another big sector which you'd mentioned is auto. So what is your outlook for that?
So automobiles, it's a mixed bag. So
Right.
automobiles has two segments. One is the passenger, cars and passenger vehicles, which includes your, cars, SUVs, and then on the two-wheeler side.
Right.
And then you also have the commercial vehicles, which are more a play on the infra and the overall, capex in the economy. So we believe, the four-wheeler, which is, players like Maruti, M&M, and the two-wheeler players like TVS and Eicher. These would be the beneficiaries of this increase in disposable income, because again the entry level cars or the entry level motorcycles were seeing a pinch in terms of demand in last few years given the pressure on consumption. So we'll see some incremental money going towards those. Whereas the commercial vehicle players like Tata Motors and Ashok Leyland, for them it's a slight negative because the capex cycle is not going to be as strong as what it was expected to be. So it's a mixed bag out there. The top picks for us in autos anyway, fortunately, were more on the consumer side names. So names like TVS Motors, Maruti and Eicher. These are our top picks in the automobile space. And I think again post budget, these are looking stronger, and even M&M because they benefit on both sides. Tractor, which is rural consumption and rural economy push, has been there in the budget, as well as their UV portfolio is doing quite well. So these four auto stocks, we would be on the positive side.
Right. So two-wheelers and four-wheelers could see an uptick.
Yeah.
What about the premium auto segment? Are we looking for any headwinds in that space?
Not really because of the budget. See, premium and luxury has anyway been doing well, and if somebody is looking to buy the premium cars, frankly, 1 lakh higher, disposable income in a year will not make them change their decision or
Right.
make them kind of buy it. So I think the benefit of this would be more at the entry level and mid level segment of passenger vehicles and two wheelers rather than the real premium end. So premium will continue to do as it was doing, which is quite good.
Right.
So there has already been good growth in that segment. We believe that would continue.
So real estate can be seen as a positive given the government's push for affordable housing and more disposable income in hands of the people. What is your outlook for this sector?
So real estate, cycle has been good on the residential side. Last few years, we have seen uptick in both volumes and prices. In this budget, the disposable income increase, as I said, real estate we believe would be one of the beneficiaries, especially again the real estate which is focusing more on the mid end rather than
Right.
the luxury because the benefit is more for salaried people
Right.
in the income bracket of 10 to 20 lakh, which means these consumer segments would typically be looking for houses in the 50 lakh to 1 crore kind of a range. So players which are operating in that price segment will tend to benefit more. We are still positive on the sector, and we believe and from some of the other steps also which the government took in the budget, overall I think they are still trying to push the real estate cycle and the residential upcycle. So our top picks in this space are players like Shobha, which is I think most of the Bangalore players should be well
Right.
positioned given the budget thing because Bangalore has a large sort of a tech population in that price point. And that income bracket which we will get positively benefit. So names like Shobha, Prestige, Brigade, we are actually positive on all three, but Shobha is our top pick out there. And some of the other players where we are positive are Oberoi and DLF
Right.
among the large caps in the space. They may not be very clear beneficiaries of just the budget per se because they operate at slightly higher price points, but nevertheless, I think higher disposable income across all income brackets will be positive for the sector.
Right, right. So if someone were to look at this space, what kind of balance sheet strengths or business models would they look at?
So see, real estate is a long cycle play typically, and it's fairly cyclical. We have seen
Right.
from 2013 to 20, nothing happened on prices, and lot of developers were under a lot of stress. So quality of balance sheets become extremely important in this segment. and therefore our preference is clearly for residential based developers, because there is a faster churn of capital and balance sheets tend to be lighter. And second is, the good part is in this last 3 year of upcycle, most of the developers have already deleveraged their balance sheet. So
Right.
DLF, which used to be net debt, is now net cash. Most of the companies, even our top pick Shobha, which used to have debt earlier, is now almost zero debt companies. So they've raised capital, they've deleveraged their balance sheets. So I think the balance sheet strength of the sector is quite good at this point of time, which is another reason why we continue to be positive from a 2 to 3 year cycle. So residential real estate is what one should be looking at,
Right.
and some of these top rung developers which have very strong balance sheets now.
Got it. Got it. So the last bullish sector that I would like to touch upon is BFSI. Are we looking at a fresh lending boom?
See, I think the budget per se will not lead to a very high credit growth compared to what was expected earlier.
Right.
So I would not say that there is a big credit growth or lending boom because of the budget, because it's not so much on the capex and infra side. But again, the good part is that if you see some of the stress which was building up in the BFSI sector and in banks in particular was on the personal lending and the unsecured lending, be it credit cards or on the microfinance side. I think this higher disposable income, in the mid segment, plus still continuing thrust on the rural side, will tend to make probably these risks recede away in a matter of time. So I think the more retail focused banks will tend to are the bigger beneficiaries of this budget. So banks which have a greater lending to retail side, because I think the retail is where you will see the credit growth uptick, whereas on the corporate side you might see some bit of a slowdown in the credit growth. So therefore at an aggregate level credit growth may not move up, but the retail focused banks will tend to benefit. So names like ICICI, Axis, which are there among our top picks. Among the PSUs, we believe SBI continues to be one of our favored pick. And I think the other good thing is the borrowing number, the fiscal deficit, all of those imply that possibly bond yields are not also going to go up in a hurry. So our house view is that bond yields will continue to be fairly benign, which is again positive from a banking perspective. And then you will have the upcoming
Right.
RBI meet, where there is a possibility of further measures to improve liquidity in the system, so which will be positive for banks. So overall we believe for BFSI it was a budget which was on the positive side at an aggregate level. But again there are nuances. The corporate lending side will see a bit of a slowdown vis-a-vis what was expected, but it will be more than made up by the retail side.
Right. So in aggregate, we would also look at lesser NPAs in the bank balance
Yeah,
sheet.
hopefully. Yeah,
Right.
because corporate side anyway, there is no NPA problem.
Right.
The
Right.
balance sheets of corporate India are in very good shape. Perhaps the best they have been in last 10 years. And the retail side is where the stress was starting to build up and where all the concerns were. And now this thing should, help mitigate those risks. The recent budget and the higher disposable income.
Right. Right. That's quite insightful. Thanks, Varun, for covering all the opportunities across various sectors for the viewers who have been listening intently. Now, I would like to touch upon one bearish sector, that is infra.
So, see, I think it is not really bearish, but I would call it there is some degree of reality
Right.
check which investors need to do in that sector. It's more vis-a-vis the expectations which were very elevated, that that will continue to be the only sector which will drive the economy. Now, I think after 3 years of possibly that sector leading the economic growth, now we are getting into a period for next few years where probably the economic growth would be more balanced. So not to say that infra and industrials will not do well as a sector, but the expectations were running higher in terms of the infra spends, the way they have been in the last few years. But this time around there was definitely disappointment. If you look at on a 2 year basis, the infra spends would be practically flattish from FY 24 to 26. which means the business models and the stock prices need to adjust to that reality, and possibly investors need to have a close look at their portfolio in these sectors, and only be in stocks where one is still confident of making money in the medium to long term.
Right.
So valuations was a concern for us in industrial space in the last 12 months, and we were cutting down our weights and kind of booking profits in some of them. But at the same time, it's not that we are going and selling away all of our industrial and infra stocks in model portfolio. Because the good part is a lot of these stocks had already seen a 20-30% correction before the budget itself, and post budget they would possibly see some more, and then even some of them might start looking attractive on a 12 to 18 month basis. So I think it's going to be very bottom up, and therefore investors should not get overly worried or on this side, or overly bullish or euphoric on the consumption side. But the point is, last 3 years if you see, most of the portfolios would be overweight industrials, infra, and underweight consumption. I think it's time to possibly reverse it to an extent, and be slightly more positive on the consumption side vis-a-vis the industrial and infra side.
Right. So, what would be your one advice to our investor viewers who have been holding positions in these sectors?
So as I said, not to get overly worried and sell all of them. Depends on which stocks you are holding. Just have a look at valuations, where they are trading, what is the growth outlook. Now again, within infra is a very wide
Right.
sort of a segment. If you see, for something like roads and railways, the spends are flattish, but for defense there is still an increase on a YOY basis. Now even within the segments, each company is different. There are still parts of I think capex story which are positive, in terms of structural plays like data centers and electronics manufacturing, a lot of the PLI schemes which are coming through. All of them will be helping some of these industrial stocks. So industrial stocks which are more catering to private sector capex, because we believe over next 12 to 18 months, possibly that segment could see some revival, the private capex, and therefore the multi-year themes in terms of shift to green energy, shift to EVs, greater manufacturing in India for stuff like semiconductors, electronics and all. Those are structural themes. So if you are holding stocks in those segments within of industrial infra, I think you are still okay. But
Right.
again, it is very, very bottom up, very stock specific, depends on what stock at what valuation are you holding. So we are not advising our clients to go and aggressively sell their portfolio in industrials and infra. In fact, in our model portfolio, we have not made much changes, just basis the budget.
So that's quite helpful for our viewers who would to not make hasty decisions while looking at their portfolios right now. I would now like to understand what would be the top key metrics that investors should look at while evaluating their current portfolios.
See, the key metrics, frankly, don't change for us when we evaluate companies. They have not changed for us over the years. So first of all, you have to look at the business model of the company. What is their moat? Where are they? Are they going to be there 5 years, 10 years down the line? Is the business model resilient enough to go through these kind of down cycles and up cycles? So, balance sheet strength always becomes one of the important parameter. Um, Obviously, I think at this point of the economic cycle, given balance sheets are very strong across the board for corporate India, both on the, even some of the leverage sectors like infra and real estate, as I said, have deleveraged now. So I think balance sheet strength is now less of a concern for us. The biggest or the single most concern for us right now is valuations, because
Right.
they are really high across the board, both on the consumption side and on the infra and industrial side. And therefore, our advice to investors is to be cognizant of what you are paying, the price at which you are buying these stocks, what valuations are they trading at, does the earning growth justify? Because we are getting into a period where earning growth is slowing down
Right.
for corporate India, and not because that there is anything drastically wrong with corporate India, but it's just that the base has become higher, earnings have got normalized across sectors, profitability from COVID low has really improved, But from here on, we believe earning growth will possibly grow at only 10%, where valuations in lot of sectors and stocks are trading at 30, 40, 50, 60 times, which we believe is unsustainable.
Right.
When I say unsustainable, in a lot of these cases, it's not that stocks may necessarily correct anytime soon, but you can have periods of very low to moderate returns in equities.
Right.
So I think right now, apart from the business model and balance sheet strength, the single most important variable for us is valuations. And I think anything which is very high in valuations, you have to be extremely careful if you are holding such stocks in your portfolio, and it has to be backed by a very high earning growth, to be the possibly the reason, if you are holding on to those stocks, because otherwise I think valuation derating in the context of how global macros are looking at, how the uncertainties are going to increase with the new administration in US. It is time to be more worried
Cautious.
and cautious on valuations than anything else.
Right, I agree. So, like in the last 4 years, I think the new age investors, none of them have yet seen a bear run as such. So that's a quite a good comment for
Yeah.
our new
So I
investors.
think the point is that the phase of very easy money in equities is over, and
Right.
from here on, it would be like any other sort of a asset class, that it gives you a risk-adjusted return,
Return.
which is commensurate to the risk that you are taking. I think the point at which we are, possibly the risks that we are taking is more than the reward which we may get in the near term. And therefore, if one is if one is ready to ride out that volatility and period of low return, there is no reason to be overly worried on equities. But be very careful on the stocks which you own, because it's not that every stock will go up in the future. Very few stocks will go up which are backed by strong fundamentals and reasonable valuations.
Right, that's quite helpful. Thank you, Varun. To conclude, I would like to summarize this in three rapid fire questions. My first question is, what are the top three picks across sectors and why?
So see, our top picks for the year, when we had put out our annual outlook at the start of the year, top picks which I would continue to run with for the rest of the year, and which have got reinforced by the budget, would be possibly Maruti is among our top picks. Overall, from financials, I would definitely like to pick one name. So it could be from the bank side, it is ICICI, and on the NBFC side, Chola. And then from the real estate, I would pick one stock across sectors, and which would be Shobha, which is a mid cap. So more tilted towards large cap overall, our picks and model portfolio, but one mid cap would be Shobha. So these are the 3 4 names.
Thank you, that would be quite helpful. So, my second question is, are there any overlooked themes that could play out in the next, let's say, 12 to 18 months?
See, I think frankly the problem in Indian market right now is that most of the themes are, already well discovered and overplayed in that sense, given very high valuations. But if I were to pick something which is not been in flavor in last 12 18 months, and which could possibly come into flavor, is the low end consumption, like
Right.
the bottom of the pyramid, which is both on the rural and urban side. So I think rural consumption as well as urban mass consumption could make a comeback, and therefore stocks and sectors which are catering to that should also commensurately make a comeback in 12 to 18 months. We believe risk reward is looking fairly attractive in that space.
And my third question would be, what is the biggest risk factor that could derail the market's optimism around this budget?
See, I think if you ask me, there is one risk factor on both sides, one on the global side, one on the domestic side. On the global side, obviously, as I said, the risk, this is going to be a volatile year in terms of what the US policy action would be. Just over the weekend, they have increased their tariffs on 3 countries, which is Mexico, Canada, and China. And this is just the start. We believe a lot more sort of policy action would continue to flow through the year. A lot of the currencies have been under pressure, including the Indian rupee. So, FIIs have been continuously selling given the high valuations. So, I think in that context, the global sort of macros can really hurt India in this calendar year, which can take away the positives which have come from the budget. On the domestic side, frankly, the main worry for us, as I said, has been valuations. So because the starting point of valuations is so high that any negative news will possibly lead to a negative stock price reaction rather than positive for majority of the market. And therefore the valuations and the low growth, we need to, I think, economic growth and the earning growth of corporate India needs to go up in FY26 compared to what we saw in FY25, which was a fairly weak year for corporate earnings. If that doesn't happen, then I think we are headed for some more correction and pain, especially in the mid and small cap segment in FY26.
Right, that quite summarizes our conversation today.
Thank you.
Thank you so much, Varun, for your sharp and actionable insights. With that, we wrap the episode of Budget Decoded by HDFC Securities.
Thank you. Thanks everyone for the patient listening.
For our viewers, the post-budget landscape is taking shape and the opportunities are out there. You just need to know where to look. Stay tuned for more expert insights, and until next time, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.